Welcome once again to the inaugural 2024 edition of the Long Only Podcast. I'm Doug. And after a few weeks off, we are back. Well, we took 1 week off, so it meant it was 2 weeks from podcast to podcast. So, but anyway, the point is we're back now. Gerry, let's do a quick market commentary. The market is marketing right now. So
yeah, we've had, we just commented that in our portfolio for growth anyway, it seems like we had our whole year in 1 month. Finished the year on a very positive note, which is nice. So that, and across the board, pretty much that was the case. We've talked about the more favorable interest rate and inflation environment. I think there's naturally going to be some backing and filling, correcting of that here in the early part of the year. But it seems that we've peaked on the rates and the inflation, and that should start to become more of a tailwind, barring that they've destroyed the economy, which I don't think they have. I mean, so I think. It's election year, generally don't have major debacles in election years. Then again, things are really weird nowadays. So who knows?
Well, you mean beyond the election itself, we don't have major market debacles during election years.
Right.
Generally. 2020 excluded, I guess.
Yeah, well, all bets were off in 2020.
Yeah, and there was a debacle, but there was also a run up afterwards. So
yeah, it ended up being a crazy year again. I mean, we're saying that a lot lately. It's a crazy environment.
New normal, Gerry. Get used to it.
I still feel that we have not seen, at least as it relates to our companies, we have not seen. This gives you an idea how long term we like to think, and we do think. We've made some transitions over the last 5-ish years, a little more maybe, out of companies that we own for a very, very, very long time, over 10 years, 15 years, 20 years. Many of those changes that we've made over the last 5 years or so, we're still far from having those businesses, the ultimate result that we're looking for, happen. So much of what we're seeing in our portfolio right now is pricing based on total speculation, a lot of guesswork, on the part of the market I'm talking about. So it's a really important time to not get shaken out of good company, good quality names, even some names. And I hate that term, good quality. So I'm sorry I said that, because I think it's an overused term.
It's meaningless too.
It's meaningless because an innovative company that has not turned a profit yet is really just up and coming and getting itself going. On the outside, it looks terrible from if you look at the financial statement, but nobody pays any attention to the innovation. We've talked about innovation being kind of ignored in the last couple of years or more. As we start to see some of these businesses come to fruition, and that doesn't mean that as soon as something happens that more solidifies their business, their place in business, or their, the solidifies that the narrative that we've believe about the company starts to come true. It doesn't mean that, okay, now we sell it. No, because it can go on for 10 and 12 and 15 and more years now, but it's become more established, but it's still a growth story. We have a lot of very young growth stories in our portfolio now that if you were to go back 20 years, 25 years, the names that were sold in the last 5 were like that back then. So we're in another one of those modes right now. And I'm not sure that there's very many managers anymore that think like that. It takes a lot of patience and discipline also on the part of the investor, our client base, because these things can take time. That's just the way it works. So anyway, got a little bit off. We weren't going to spend a bunch of time on markety stuff or technical stuff. So enough of that segment.
All right. Well, one thing I want to say, just add. what we're seeing is a lot of our companies are what I would call adolescent. They're still waiting to have their big paydays, and so it is important for investors, both with regards to the companies they're investing in, but also in your personal financial situation, to not over apply what people are saying about the market broadly to you. Could very well be you have some friends who are undergoing some problems, depending on what industry there are. Maybe if it's tech and it's mortgage, they're having a hard time of it, and that's not fun. But that isn't necessarily your experience. So it's important to run these things through the filter and make certain that you're living reality, your own reality. That could sound really progressive, but
we normally get from Doug.
Exactly. Use your own experiences to make a judgment. Take it into account what other people are going through, but use your own experiences both with regards to the companies. Is this a fly-by-night company that's just pure speculation, or is this an innovative company that just hasn't reached its mark yet as its desired point? So all these background things are important to keep in the background and to consider, but don't let them become the story for you if your personal experience is different.
But Doug, tell me how you feel.
I feel we should move on to the next statement, which is your personal finance tip of the week. Gerry's been obsessing over this aspect, and this isn't just the latte factor. This is the latte factor as filtered through Gerry's personal experience.
The latte factor. Well, latte would add a little bit even more of a twist to it. We've talked about this idea of you can do things as it relates to food, which we all like. You can cook for yourself and go not go out to dinner and to lunch and to cafes and save yourself a lot of money. And so we decided to take another angle, look at another angle on this. This is I'm going to call it the espresso angle, less than the latte angle at this point, because I have the numbers better figured out for the espresso. So you go let's say you buy an espresso every day, and you go down to whether Starbucks or whatever your local roastery is. And do they roast at Starbucks? I don't know. But
if they do, they over roast.
They don't do it. Yeah, they don't do it on location, I don't think. But I digress.
Starbucks is an over roastery.
Okay, so. An over roastery. So neither here nor there. I think it's fair to say that you can pay $5, and if you do it one a day, and let's just say you literally every day, so 365 days a year. At $5, I think it was $820.
$825 what we got.
$25.
That's no tip. So your barista hates you.
Yeah, so not tipped anybody. So you're just $825 worth of espressos. Most young people don't think about buying an espresso machine. So I went and bought a Breville espresso machine for call it $500. It was $450 plus. So $500 with tax. And I like those more manual ones. So there's nothing digital. You can get crazy. I mean, you can spend $4,000 or $5,000 on these darn things that do stuff that is beyond making an espresso. And in digital ways, which to me, the digital stuff just breaks and it's a pain in the neck. So you buy a generally manual, which is fun. Once you get to do it, I feel like it's fun. You're playing with the pressure and all that stuff, the grind and how much and all that gizmo stuff. But so $500, we figured a 12-ounce whole beans bag is about $12. You can obviously pay more for that, but what we've been buying is $12, and it's perfectly good, fresh whole beans. Bottom line, we came up with about $105, I think it was, worth of coffee expense in the actual beans themselves. You're going to, at $1,825 a year, you're going to pay for that espresso machine in a little less than 4 months, like 3.5 to 4 months, just like 3.6 months, I think it was. So there's just another example. I mean, think about it. If you took the savings from going to the cafe every day at $5 a pop, and if it's a latte, I think it's more. It's closer to $6 probably. So go buy yourself some milk and spread that out. That's not going to be so bad. And save that money, invest it. So we're going to keep doing this kind of analysis just to keep throwing out to people how they're, even when you're thinking you're not making enough money and, oh my gosh, it's so expensive. And yes, it is. I mean, this is what I do. I mean, I can afford a $5 latte every day or espresso every day if I want. But I mean, heck, this is what I do. And I think, and it really makes financial sense. So that young person that's out there, begrudging how expensive everything is, well, stop. Don't do that. Heck, buy your espresso machine and bring it to your office and stick it on your desk, and don't let anybody else use it if you want, just for you.
Charge them.
Charge them. There you go. That's even better. You can use my espresso machine, but it'll cost you. You go down to Starbucks, they're going to cost you $5. Charge you $5. I'll charge you $4 or $2, and you got to make it yourself. Bring your own beans.
They've got ghost kitchens. This is the ghost espresso machine,
Yeah.
where you have to do everything yourself.
Yeah. Anyway, try that on.
Okay. That's a good tip.
We want to do more of this. This is like the foodie segment, the foodie and finance segment. We'll do more.
It's definitely a way to save money. I just drink too much coffee to buy it all the time. So,
well, yeah, if you're Doug and you have 12 cups a day, then you're really messed up if you're thinking you're going to Starbucks. He could put he might be able to put all of his kids through college on what he would spend at Starbucks every day.
I hope they're not college material, because I can save a lot of money on that.
True.
But you have enough, and at least one of them is, and I think at least, I think I'm going to be paying for some college.
Mm-hmm. Or not.
Trade school.
There you go.
But again, different strokes for different folks. Some of them might like trade school.
Another segment, by the way.
That is another segment. I started to that point though. We watched, just out of the blue, there's a division in our family, and it lies on TV a lot of the time. But my oldest, who is very likely going to go to college, he's going to have that session. But he likes Dirty Jobs by Mike Rowe, and they've started making new episodes again. They resurrected the series. So
I've never seen it. I've heard of it. I've never seen it.
Yeah, he's a big advocate for the trades.
Okay.
So, and he talked to this gentleman who was in a family business yesterday, who was on yesterday's show, I should say, or the show we watched yesterday. He was redoing vinyl pools, and this often involved rehabbing them. So this is in Florida, where they have more of a need for this, and that's how they roll. And this guy said he made grossed about $500,000 a year, says he keeps his margins at 50-50. Wow. So he's making clearing $250,000 a year doing these. I mean, I would call this generally, unskilled, skilled labor kind of. It's something where there's technique, but it's not like you need to go to school to do it. There's a right way to do it, a wrong way to do it.
Not a machinist.
Yeah. So, and this guy obviously had his system down and wasn't afraid of hard work, and he was making $250,000 a year. So, replacing custom pool linings.
Or custom pool.
Yep. Moving onward to the final thing we're going to talk about today, we're going to touch on that age-old question of not necessarily real estate versus stock market investing, although given that money is a finite resource, any money you invest in real estate is money you can't invest in the stock market by definition, and vice versa. But maybe you can have the best of both worlds if you do it Gerry's way. We're going to talk about whether you should pay off your mortgage or not. So it is important to remember, obviously, distance and mileage may vary, your personal situation may vary, but we're going to run into, and we're going to delve into the argument as to whether you should be in a rush to pay off your mortgage. I know what Gerry's going to say. So
what's Gerry going to say, Doug?
Gerry's going to give one word with a contraction in it. Don't. In terms of pay off your mortgage.
Yes, don't. Obviously, in the last year, as we've seen such a significant rise, the biggest, fastest rise in interest rates in 50 years since the 70s. 50 years. Even in spite of that, I would still say and this isn't pay off your mortgage. For sure, you don't want to pay off your mortgage if you got your mortgage 5, 6, 7, 8, 9 years ago.
My mortgage is the most valuable thing I own. My mortgage rate, yeah.
It's gold. But the question comes up now, rates being where they are, with, give or take 7%, I guess they got up 7.5-ish and even higher. Now they've come back down. Mortgage rates have come back down. I don't know that they're under 7 yet. Probably on their way now. Mind you, the first mortgage I ever had was like 9%, in the 80s.
It's important to keep that in mind. It's not the absolute rate of mortgage that is killing us so much as the relative rate compared to what it used to be and the speed at which mortgage rates increased, because from a historical basis, we're still very low.
Yeah. And the question of how is the housing market going to adjust to all of this is way more technical. I want to stay super simple in this and even not ignore the interest rate, because not ignore that rates are higher and it's more expensive. I think what that requires is being more diligent about how much you pay for the property that you're going to borrow to buy. Okay. Which is obviously going to be a drain on real estate prices or a drag on real estate prices. But again, I don't want to get into it. It's more just as far as the mortgage, and particularly if you are getting a mortgage that is below, and I think the numbers are something like 800,000-ish is the amount of mortgage that you can have. And I think it also depends on how much money you make. But I think it's somewhere around there, maybe it's 750,000, that you can still deduct the mortgage interest. So we like to talk about mostly, the Espresso story was about younger people and how to get ahead and how to save money and how to invest money and how to come up with the money to invest. Well, we give you this, what might seem like silly example on the Espressos, but actually it's not when you consider the difference. There's another, $1,700 a year that you can invest, which makes a difference when you're in your 20s. Big difference. Obviously, this is a much bigger ticket item when you're talking about people that are in their 20s, early 30s, wanting to buy a house, start a family, buy a house. Likely, even in this real estate environment, meaning how expensive a home is, you're still going to be under those levels where it's fully deductible. Depending on how much money you make, that can be anywhere from a quarter to, if you really make a good amount of money, a quarter on up to 40 and plus % of return back, if you will. In other words, if you're paying 10% for a mortgage, just to make it simple, which I don't think anybody is now, but if you were, it would be like 4%, 3 to 4% coming back to you in the form of tax break, because it's all deductible against your income. So that in and of itself, that right there makes for a good argument for why you would want to borrow to buy your home. Additionally, because that's such a big ticket item, it takes a lot of money to put down. It's what can I earn on that money that's costing me X percent. So if it's a 7% mortgage and the net after tax breaks is, let's keep it simple again, is say 5%. Can you earn more than 5%? Long term, certainly you should be able to earn more than 5%. If you look at just simple stock market returns over time, they're 10, 11-ish percent over decades and decades and decades on average. Not every year, of course, but on average. Needless to say, it's a 30-year mortgage. If over that 30 years you're taking the difference that you would pay, putting all that money into the piece of property and not investing any of it in the market, you've missed an awful lot. I've benefited in my career, closing in on 40 years now, by being in a relatively dropping interest rate environment. It's been a historically high interest rate environment, frankly, until the last 15 years or so, where we got hooked on these 0% interest rates. Of course, that 0% was at the mortgage market. But the Fed keeping Fed funds rate close to zero or at zero has left mortgage rates very low. I think I don't know what they bottomed at, something like 2 3/8 on a 30-year fixed, or 2.5 on a 30-year fixed a couple of years ago, which is just insane. We should have borrowed all you could at that point. But my main point in this is, even with higher interest rates, over time, you're better off financing with a mortgage, because it's, the way I would say this, it's the best terms you're ever going to get for borrowing money is a first mortgage. Where else can you get somebody to give you money spread over 30 years, at even now maybe mid to high mid single digit interest rates, with a tax break associated with it? Yeah, I mean, and you can do, if you do just a traditional principal and interest over time, it amortizes. You're paying down a little bit of that debt, a little bit of that debt. I always prefer interest only. That's my preference, just because I want to have complete control over my principal. But that, obviously it works against you when the years where the market's not doing well. But this is meant to be this is 15, 20, 30 years. You're going to be better off having borrowed. Now, what this, is a massive implosion in the real estate market that's systemic and lasts for decades. Kind of don't think that's going to happen. As much as I disagree with the way the tax code goes as it relates to real estate, it's going to benefit real estate. So there's a lot of things that are lined up as far as, ownership of your home, borrowing to buy your home. I wish it wasn't that way, frankly. I really do. I wish a home should be and is a consumer item. But because of the way the tax code is structured, the way, for that matter, the way society is structured, it is what it is. This is the hand we've been dealt. We need to play it. And I can tell you, again, in my career, I've benefited from a relatively consistent dropping in interest rates. But having this discussion with people who are like my peers, my age group back in 30 years ago, who wanted to, because they heard their Depression era parents say, pay off your mortgage, because they remembered when grandma and grandpa lost their house in the Depression because of the horror that happened. That was then. This is now, and this has been the last 50 years. It has not been that way. Again, I don't necessarily even agree with it. A lot of it's propped up, but that's what happens. That's what they do. Those folks that listened and smartly financed the purchase of their home really did very well. Really did very, very, very well. Had they not done that, frankly, they would not have done that well. I would argue and do argue that you're actually taking less risk by doing that, because think of the alternative. If 30 years ago you bought that house in the San Francisco Bay Area, one of the hottest real estate markets of the last 50, 60 years, and let's say you paid, hard to believe that you could buy a house for $300,000 on the peninsula in the Bay Area, but you could, because I did it back in mid 80s, 1990-ish, actually.
This is peak Full House for those of you playing.
Yeah, exactly.
You got Danny Tanner, you got Uncle Jesse, all in San Francisco.
But imagine if you had not taken advantage of putting 20% down on a $300,000 home. So you put $60,000 down and you borrowed the other $240,000. That $240,000 staying invested over the last 30 years in a good quality portfolio of companies. Oh my gosh. I mean, you're so far ahead of the game. And that's despite the fact that house is now worth $1.5 million. Okay. So what? You still own it. If you're still there, you still own it, and you got that appreciation. And you also have the other $240,000 worth of assets. If you had that much, if you could have done 300,000, let's assume you could have put 300,000 in the house. Instead, you invested that 240. My gosh, the numbers on what that's worth is many millions of dollars. It's dramatically outperformed the real estate, even in the Bay Area. So will that continue to be the case? I think it probably will. maybe to different degrees, but I think it will continue to be the case. I remember saying to somebody back in that day, that time frame, look, we're not going to benefit. By the way, that house that in 1990 was worth actually it was $285,000 that I paid. In 1950, we had the little sticker in the garage from when it was first built in the baby boom era. In 1950, I think it was 8, and it was $5,600 for that house. So from 1958 to 1990, that house went from $5,800 to $285,000. Today, that $285,000 house in that area is worth maybe $1.67 million. Sounds like a big increase. Not really. Nothing close to what 5,800 to 285,000 was from 1958. I mean, that's only 32 years.
Biden wasn't even president then. So how does that inflation happen? I don't understand it. So,
but despite that inflation, I mean, yes, that was incredible inflation for those 2 years. It was Jimmy Carter.
yeah.
It was Joe Biden too, or actually Joe Biden won. Anyway, here we are. Making the point that it does make sense. It does make sense to continue to purchase a home by financing it, especially if it's your first home.
Why, especially if it's your first home?
Well, when I mean by first home, I mean it's your primary residence.
Okay.
Yeah.
Gotcha. Okay.
And maybe you could say because it's your first home, because those are the folks that are having to stretch so much to do it. So when you do that, you want to, as much as possible, be making sure you're investing elsewhere. And that's where the less risk comes in, because the person that just did nothing, took everything and put in that house, they're completely dependent on that house. I'd rather have exposure to that house. I need to put a roof over my head. I've got to pay rent. I might as well pay it to myself, or pay it to the bank. It's like paying it to yourself in some ways, because you still own the house. And have a diversified portfolio of companies as well. It's actually, I think, less risky.
Well, and you can also argue, you mentioned this before, but having access to your capital, the problem with real estate, I wouldn't say this should be the defining consideration, but one thing to consider is even when that house is already paid off, you've got a permanent lien in the form of taxes, real estate taxes. So you're never completely free of the man. And if you've got your equity tied up in that house, and for some reason you find yourself with the inability to pay taxes, then suddenly all that equity, in either situation, whether it's borrowed or not, you quote unquote lose the home in this disaster scenario, but you lose the equity you have in the home as well. And if you don't have a lot of equity in it, then you're much more nimble, and you're not as at risk over that kind of seizure. Now we're talking about a pretty extreme example. If you've got a $500,000 house, which is the median value of a house is approaching that in this country, $500,000 house, you can't come up with the $4,000 worth of taxes that it's going to take to stay in it. So I don't want to make a broad point with a very specific example, but just realize a lot of people talk about how you pay the house off, you pay the mortgage, you're free. Well, it's a little more complicated than that. So
you really don't want to do that. And actually, as George Gilder has taught us as he's emphasized this time price theory of economics, and even more exacerbated if you use my espresso strategy, incomes are keeping up. Over time, they've kept up significantly. The amount of time it takes to earn the money to have that mortgage is much less today than it was 30 years ago.
Gerry financed the espresso machine and has really taken it to the next level.
I think it's interesting. I wonder how long espresso machines last. I haven't gotten to that yet.
We're 2 years for the one in the office.
As long as they're not digital, they probably last a long time.
It's probably true.
Should we wrap there?
I think we should.
Okay.
Please go to our website, taylorfrigon.com, learn about our firm, our mutual fund, about us. And we are on Instagram, taylorfrigon.invest. Email us longonly@taylorfrigon.com. Thank you. And also, please remember, subscribe, smash the bell, as the YouTubers say. Subscribe, tell a friend, share this. And until next week, I'm Doug.
Happy New Year.
And Happy New Year.
I'm Gerry.
Thanks for joining us on the Long Only podcast.